Another really popular request people have that I go over is the PIMCO Dynamic Income Fund, which is ticker symbol PDI. This is just one of several high-yielding funds offered by PIMCO, with some of the others being RCS, PTY, PGP, and PCM. All of these funds currently offer yields of over 12%, with PDI currently offering the highest yield at nearly 14%. Other than the extremely high yield, there are some other really attractive things about this fund in particular. For one thing, it pays dividends on a monthly basis, which is always more appealing for investors seeking income. Not only that, but in its more than 10-year history, PDI has never cut their dividend. Out of all the PIMCO funds currently yielding over 12%, PDI and PCM are the only ones who have never reduced their dividends. At the same time though, PDI is a fund that's also been wrecked this year. It's currently trading at its lowest price in this fund's history, even lower during the 2020 pandemic plunge. Its year-to-date performance is negative 27.5%, which is slightly lower than the S&P 500 without dividends being factored in. So in today's video, I want to go in depth on this fund and try to find out why this fund's share price has been tanking so much, and more importantly, we're also going to look into that monthly dividend to try to figure out if it's sustainable going forward or if a cut might be coming. We'll also see if a recovery in share price could be coming anytime soon. So the PIMCO Dynamic Income Fund is a closed-end fixed income fund that invests in fixed income markets across the world. PDI invests in multiple fixed income sectors, including non-agency residential and commercial mortgage-backed securities and below investment-grade securities as well. But PDI primarily invests in mortgage-backed securities, investment-grade, and high-yield corporate bonds. Income is the number one objective for this closed-end fund, with capital appreciation being second, although historically speaking, this has not been an investment for people seeking growth. Additionally, the fund uses leverage in an attempt to help boost income and was launched over a decade ago, back in May of 2012. As previously mentioned, since their IPO, this fund has never reduced their dividends, which it currently pays 22.05 cents per share every month. They have grown their dividend a couple times, but it hasn't been raised since 2015. Additionally, this fund has paid special dividends every now and then, but they haven't done this since 2019. This fund does have some similarities to another one we looked at about 2 weeks ago, which was the Guggenheim Strategic Opportunities Fund, which is ticker GOF. Like PDI, GOF is another fund that pays monthly dividends and now currently yields over 14%. I'll leave a link to that video in the description if you want to check out another high-yielding investment option. But with PDI, we can see this fund's share price is down a lot this year, as it's currently down about 27.5%. In reality though, PDI's share price has been falling a little before the year 2022 rolled around. If we expand the share price history further, we can see that it's been going downward since about June of 2021. Compared to back then, it shaved off about a third of its share price, but at least the dividends have remained consistent. So looking at this information, let's try to determine why the share price has been falling so harshly and if we can expect a rebound anytime soon. Let's also take a look at the health of this fund's dividend payments and see if that's currently in danger. For starters, if you're not aware, PDI is what's known as a closed-end fund. If you already watched the Guggenheim video, I already went through what a closed-end fund is in that video. But I'm going to briefly go over what closed-end funds are again, so I apologize if this information's a little redundant. Feel free to skip to this timestamp if you want to pass through the CEF refresher. But closed-end funds are pretty similar to exchange-traded funds and open-end mutual funds. They're a type of pooled investment security that hold a wide variety of different investments. Anything from bonds, mortgages, stocks, or other closed-end funds, and more. They offer investors diversification, which is one of the most important things that all investors should be looking for. But closed-end funds do differ when compared to ETFs in your regular mutual fund. Here's a chart that I presented many times on my channel before, made by the people at Hoya Capital. You can see how closed-end funds compare with ETFs and your typical open-end mutual fund, like what Vanguard and Edward Jones offer to consumers. They're all diversified investment products that hold a collection of different types of investments. But what sets CEFs apart is that they use leverage in order to boost returns on their holdings. They're also actively managed funds, meaning you have a team of people who hand-select everything that goes into them. This results in CEFs charging higher expense ratios than the other two investment types. There's also a fixed amount of shares of a closed-end fund, whereas ETFs and mutual funds can change their shares depending on the demand. So with this in mind, let's get back to PDI and figure out what's inside this fund. According to PIMCO's website, this fund invests in a wide variety of different types of debt. We can see a breakdown on their website as to what kind of debt it holds, which shows PDI contains mortgages, emerging market bonds, high-yield corporate bonds, as well as municipal bonds, among others. But the number one largest holding in this fund is something called non-agency mortgage-backed securities, and I want to focus a good amount of time on this. A lot of people don't like investing in any kind or variety of mortgage-backed securities because I think they can be considered a controversial type of investment. MBS has played a big role in the 2008 financial crisis, and if you've ever seen The Big Short, you might be well familiar with what these are. Mortgage-backed securities are basically a pool of mortgages purchased from the banks that issued them and are then sold to other banks, financial institutions like PIMCO, or individual investors. They're kind of like bonds in that investors receive periodic distributions similar to bond coupon payments. If you remember back in 2008, banks would issue mortgages to people who didn't have decent FICO scores or couldn't even prove that they earned enough to actually make payments on their mortgages. The banks would then bundle these mortgages together into mortgage-backed securities and then sell them, and they'd be advertised as being safe because they were so well diversified with thousands and thousands of mortgages in each one. But as most of us still remember, after enough people defaulted, these MBSs began to fail, and the rest is pretty much history. This is probably the biggest issue that makes people skeptical about this fund. What probably turns off people even more is that nearly all the mortgage-backed securities in this fund are non-agency MBSs. Agency MBSs are issued by the Government National Mortgage Association, or Ginnie Mae, Federal National Mortgage, or the Federal Home Loans Mortgage Corporation. Ginnie Mae's MBSs are completely backed by the United States government and are free from default risk. MBSs issued by the other two organizations used to be chartered by the government, but they aren't anymore. Regardless, defaults from these two have still been fairly low. Non-agency MBSs, on the other hand, which is what PDI mostly holds, are not guaranteed by the US government or any government-sponsored enterprise. Both types of mortgage-backed securities are also commonly found inside mortgage REITs, with Annaly Capital and Armor Residential being two examples. But I think investors need to keep a couple things in mind about MBSs, which is that following the financial crisis, the US government created stricter laws and guidelines that made these types of investments safer than they were before the financial crisis. With the passing of the Dodd-Frank Act as well as other regulations, the mortgage-backed securities that we see today are much safer than the MBSs we had before 2008. They're still riskier investments than other types, but because of the stricter regulations, it's very unlikely that MBSs would collapse like they did during the financial crisis. Still though, many people are still wary of these kinds of investments, which is understandable, but they are better today than they were more than a decade ago. So now that we know what's inside this fund, let's turn our attention to that dividend yield. At nearly 14%, we need to figure out if PIMCO is going to be able to keep it despite the falling share price. There's a document on PIMCO's website which is called their Unii Report. This stands for Undistributed Net Investment Income, and it shows that the fund has been able to cover all the dividend payments to shareholders. According to this file, if we scroll over and look at PDI specifically, we can see the last 3-month rolling coverage ratio for this fund is 126.7%. Their fiscal year date distribution coverage ratio is slightly higher at 130.9%. This means that up to this point, PDI has earned more than enough from the debt inside their fund to fully cover the dividends being paid to shareholders. With coverage this high, based upon what I'm seeing, I'm not noticing anything that would indicate that PDI is in danger of cutting their dividend anytime soon. So if the dividend appears safe for the time being, what explains this massive dive in their share price this year? The biggest culprit of this would have to be interest rates. PDI buys debt, and when interest rates rise, the price of existing debt declines. This actually results in a positive thing for this fund because when the debt inside of it is paid off by the debt or mortgage holder, PIMCO takes the money and reinvests it into new mortgages and new debt, which are now yielding higher. When the feds raise interest rates, it's going to lower the value of this fund's debt portfolio, which helps explain the falling share price for this year. As of the making of this video, the feds still have 2 more meetings this year. If they continue to raise interest rates due to inflation, then PDI's debt portfolio will continue to suffer going forward. I personally think the feds are going to keep raising interest rates, which should result in the share price of PDI to keep going down, at least for the time being. So even though the dividend still appears safe, if you're interested in opening a position in this fund like I am, I'd actually suggest waiting a while. I've been holding off for a while on this fund until the NAV stops going down so much. But once the Fed stop raising interest rates and debt prices begin to level off, which will probably be in 2023, that's when I'm hoping to get in on this fund. At that time, the share price of PDI should begin to recover. So until then, I'm just waiting off here on the sidelines. But as I always like to say, be sure to perform your own research and due diligence before making any investment decision.